Hey guys, it's Carter. Welcome back to the channel. Now in today's video, we are going to be talking about the top 6 ways to prepare for a stock market crash. We've seen a little volatility in the market today, so we're going to be talking about pretty much ways to prepare. So I hope you guys all enjoy it, and if you guys learned something, make sure you guys hit that like button and subscribe. Make sure you guys do that because it really helps me out. And if you guys want to learn more about investing and trading, check out our school. You guys can get 50% off by using code SCHOOL. We have private live streams. We got quizzes, lectures, a group chat. It's an 8-week course where you guys can learn how to navigate and trade the market. So check it out down below. It's called the Swing Trading Masterclass. It's absolutely fantastic. So guys, let's dive into this here. So how to prepare for a stock market crash. So the first thing that you guys need to do is be diversified. Spread your investments across different asset classes like stocks, bonds, real estate, commodities, and cash. This reduces exposure to any single asset that might crash. So we might have a stock market crash, but we might not have a real estate crash or a housing crash. So the biggest thing is just be diversified. Never hold more than 5% in a single stock for long-term investing, and never hold more than 20% of your portfolio into one given sector. Another cool little tip here is hold stocks from different industries, obviously like technology, healthcare, utilities, to reduce sector-specific risk. I think we all know that right now artificial intelligence is squeezing and hitting all-time highs almost every single day. So that could be a sector that maybe you want to start limiting it just because you hear that expression, buy low, sell high. You know, we're seeing these companies up like Nvidia up 130%. And, so we could have a little bit of a temporary pullback where other sectors perform a little better. Another thing that you guys should do is just increase your cash reserves. Having cash, having a cash buffer gives you flexibility. You can use it to buy undervalued stocks during a crash or as a safety net if you need liquidity. So if you enter a stock here, you always hear that expression, I guess, buy low, sell high, right? You always hear it. If people are learning to buy stocks, you go, oh, buy low, sell high. Historically, crashes represent the best opportunity to invest. Historically, if you guys invest during crashes, the average return rate of your portfolio goes from 10% to about 20%. And that is just buying at those lows. So you sell off as opportunity and don't get fearful of it. Having cash is very important as well, because often stock market crashes happen for some reason. It could be high unemployment, could be high inflation. So having cash is very important just to pay your bills and keep you afloat. Another thing that you guys can do here is invest in defensive assets like bonds, like gold or precious metals, or dividend paying stocks. So bonds, a government and high grade corporate bond, tends to perform well when the markets are volatile. Another thing, gold and precious metals, historically, these tend to rise during market volatility because people want something tangible. They want something physical, and historically, when people get fearful, they go to gold or precious metals. Another thing, obviously, is dividend paying stocks. Historically, dividend paying stocks don't fall as much because they're paying cash flow to their investors. People are less likely to sell their shares if they're guaranteed pretty much dividends every quarter. So invest into some high dividend paying stocks. Companies with strong cash flows and dividends are usually more resilient. These are going to be companies like Coca-Cola, Home Depot, Johnson & Johnson, companies that, maybe don't have a huge amount of growth, but more stable balance sheets, that have, a decent amount of cash in the bank, all that. Another thing you guys can do is just focus on high quality stocks. Don't go high risk, high reward. Stick to the basics. Stick to companies that you use, on a day-to-day. Invest in companies with strong balance sheets, consistent earnings, and a history of surviving economic downturns. These companies are likely to weather a market crash better. So, companies that have been around the block, right, that have gone through crashes that have gone through market volatility are going to be companies that perform better, like Disney, like Coca-Cola, like Apple, Google, Meta, Microsoft. Companies that have a good amount of cash, good balance sheets are always a high contender. And another thing I always like to look at is something called the cash on hand. This is a metric a lot of hedge funds use to invest in the companies during downtimes, because what we have a tendency of seeing is stocks sell off, right? They get a bunch of sell off, but imagine if you're investing into Microsoft, and Microsoft has $120 billion in cash. So when they're going through this hard time, they have enough cash to continue to pay their employees, continue to invest in products, and continue to roll things out. That's a little metric a lot of people use as well. Another thing here is just limit leverage. Leverage, for those of you that don't know what it is it's borrowing to invest. So reduce or avoid margin trading. That's borrowing to invest during periods of market volatility. I don't recommend it at all, but if you're already doing it, I would definitely limit this. Leverage amplifies losses during downturns. When you take that loss, maybe your normal loss is $100. Maybe now it could be $1,200 or $1,300 when you have leverage, because there's so much volatility in the market that when we get sell-off, it amplifies it. Another thing is just have a long-term mindset. Understand that markets, it's healthy for a market to sell off and crash. Use that opportunity to invest. And you guys can see this right here. This chart represents the S&P 500 from You guys can see it from 1980, but it goes all the way back in here to 1960. You guys can see from 1980 all the way to 2020, we've had an average return rate of about 10%. So that's going through the 2008 crash. That's going through the 2020 crash, the dot-com bubble, the 80s crash, all that stuff. So if you're gonna trade or invest, just have that long-term mindset. You'll be way better off for it, because you'll actually look at market volatility, market crashes, and kind of be happy about it. I know that sounds crazy, but you'll be happy to buy stocks that you like at just a cheaper price. I think that a lot of people get nervous around crashes, but you gotta look at that as opportunity, guys. So guys, that is it. Those are the top 6 ways that you guys can prepare for a stock market crash. I hope you guys all enjoyed it. And if you guys want to learn more about investing and trading in the market, check out our school. You won't regret it. And hit that like button, subscribe, and we'll see you guys in the next one. Take care.